Welcome to the Ezra Digital 2021 Education Series. I would now like to turn it over to Margot Tank for introductions.
Thank you, Mallory. I'm Margot Tank. I'm a partner at DLA Piper and the U.S. co-chair of the firm's financial services sector. I've been advising clients on electronic signature and digital transformation matters for over 25 years. I am one of the co-chairs of the Ezra Education Series, along with my colleague, Steve Bisbee. Ezra members are dedicated to providing, promoting, and participating in Ezra values, which are expertise, leadership, collaboration, accessibility, and technology neutrality. As part of Ezra's educational mission, this is our second annual education series, and it will run through December. The intention of the education series is to provide insight and practical guidance on the business, technology, and legal implementation issues that arise across a wide spectrum of use cases. Although eSign was enacted over 20 years ago, there is still a learning curve as companies continue to transform their business practices. These issues are of even more critical importance during this time of social distancing, remote work, and contactless consumer engagement. We hope you will find these webinars useful. I would like to introduce our moderator today, Steve Bisbee from eOriginal, a Wolters Kluwer company. Steve is the president and founder of eOriginal, a provider of a leading digital transaction management platform for financial services. Steve oversaw the development of unique digital solutions that have replaced paper processes, expedited transactions, and created business process efficiencies for over 600 clients in a digital financial ecosystem. Tim Berniston is presently a senior advisor and regulatory strategist for the senior leadership team at Wolters Kluwer Compliance Solutions, a post he took after leading the company's consulting and professional services practice for many years. Before joining Wolters Kluwer, Tim had a long career in the federal government, leading the compliance examination, supervision, enforcement, and policy functions at the Federal Reserve, the FDIC, and the former OTS. He also led the U.S. Treasury implementation team that established the large bank examination program for the CFPB. Valerie Day is Director of Digital Lending Product Management at Wolters Kluwer. Val has been driving digital lending adoption since 2003 and has enabled lenders to achieve many industry firsts. As a subject matter and technology expert, Val provides industry focus, foundation, and enablement strategies to achieve full digitization of the lending process for consumer, commercial, and housing finance enablers. Please welcome Steve, Tim, and Valerie. We're really excited to have you here today.
Thank you, Margot. Good afternoon. Thank you for taking your time today to join Tim, Val, and myself. We've all seen and experienced many types of transition from paper processes to digital. In business, in our personal and social lives, how we communicate and gain knowledge, and how we engage and transact with others. There have been certain waves of this digital transformation, some very small, and some more like a tsunami. As Margot just mentioned, the capability to execute electronic mortgages has existed in different forms for over 20 years. But now every aspect of the process needs to be compliant with technology solutions for digital enablement. We're now beginning to see another wave building on those before it. Okay, so each wave, each wave of digitization, it was driven by fundamental process and technology changes. When you look at the first wave, the process change was primarily in the front end processes, including loan application and underwriting. Borrowers were looking to be able to have the same type of experience in their lending transactions as they had in their retail purchase transactions over the internet. Initially, that was not possible. Many of you remember dial-up and the lack of true broadband access. But when we did get broad internet infrastructure and access enabling online transactions, you were able to move beyond retail, and we began to see the utilization of digital processes for the actual transactions, including the closings in mortgage. But it was very, very slow in terms of its adoption. And it really was driven by the borrower experience and the lenders wanting to fulfill the desires of the borrower. Mallory? The second wave was more of the tsunami. We ended up when the COVID pandemic began, it really accelerated the need for fully digital mortgage closings. And it wasn't just that they needed to be executed with electronic signatures and electronic documentation, but you had to be able to do it remotely and contactlessly because of the issues around the COVID pandemic. So the mortgage processes, documentations, and all communications had to be able to be done digitally. This created remote notarization, settlement, closing, and also the back office operations had to be able to be executed in many ways remotely, as people were not able to go into brick and mortar facilities to enable them. So we had the technology tools now that came to the forefront, like for e-signatures and e-notes, but also we saw legislative enablement to enable mortgages and other types of asset transactions like automotive to be able to be executed remotely. So we had especially around the remote online notarization, which Margot has been very much involved in. But as a result of this, there was not one solution. There were many, many different approaches, from hybrid, where you had both paper documents and digital, and to completely digital documents as well. But what came out of this was an understanding that from a regulatory and business perspective, you had to have a continuity in the process and the technology, which enabled you to have compliance throughout the process. Mallory? So when we're looking at now, and we talked about, what is it that we're beginning to see? We have an increase, the processes are the same, but the imperative to have them digital has increased, and the amount of technology that is available has increased in its adoption. And people are reaching out to capture this technology. And it's resulted in increased automation and intelligence in regulatory compliance operations, because the digital lending technology value now is going to be able to be captured while mitigating the ongoing compliance risks. And you'll hear from Tim and Val about how that can get done. The technology is an emerging and competitive differentiator, meaning that if you do not have this, you are not going to be able to stay ahead. You're not going to be able to stay compliant. So this is something that is we really view as a third wave. We're seeing it in mortgage, and we're seeing it across all the different asset classes. It's basically going to become unavoidable. We're seeing the utilization of things like artificial intelligence and machine learning. Now the questions become, what is the timing for this? What are you going to need when? How are you going to accomplish this? How are you going to ensure that your digital operations are going to meet the requirements of both regulators, investors, secondary markets, throughout their life cycle? Next. So what's driving this third wave of digitization? It's risk management. All financial services transactions are driven in many ways by how do you mitigate the risk of non-payment, of making sure that you're compliant with all of the various consumer rules and guidelines as you're going through these transactions. So you have to have best practices in your processes and making sure you have a full regulatory compliant process. And it's different today because it's across an asynchronous, meaning there are many different many parties in the process, many different stages in the process, many different technologies utilized for each individual mortgage. What technology is being used for one origination is not another, what's being used for e-notarization is not another, how it's going to get recorded and managed is also not the same. So how do you manage these as you look at solving this problem for this third wave of digitization? So Tim's going to speak to the transition from reactive to proactive to make sure you have compliance management. Val is going to speak to the issues around the technology. Tim,
thanks.
You would? Go ahead.
Thanks, Steve. Just a word on the last slide before I jump into transitioning from reactive to proactive compliance. And that's the whole idea that digitization is also in the regulator's bullseye, and it's because the whole concept presents, I think, a lot of benefits for consumers, but at the same time, as you very appropriately pointed out, it also presents risks. it presents risks not only to an organization providing it, but to consumers themselves. Regulators, best I can tell, are simultaneously looking at digitization as a tool to advance the diversity, equality, and inclusion movement, as well as an area of concern that could actually damage the continued movement towards the democratization of credit. So it's something that becomes very much in the interest of both the regulators and the industry to proceed in a way that gains solid consumer acceptance. And widespread consumer adoption of digitization is largely dependent on that acceptance. That acceptance is really dependent upon trust, user confidence in the technology and the firm behind it, the reputation of the firm, fair access and responsiveness to inquiries and complaints that people providing the technology might receive. So with that as just a tag on to your general intro, I can sort of walk through the first area or the first driver, which is transitioning to a proactive compliance risk management approach as a primary driver. It's actually really I think a basic precept here. And let's just sort of talk a little bit about what it means. Understanding the priorities of regulators, that seems to suggest that you should just go without saying, but you'd be surprised to what extent folks are generally unaware of what the regulatory community is thinking about, looking at when they are evaluating a technology and a growing technology, as well as a product and a service. The priorities of regulators are actually pretty easy to find. They're very readily available. Every federal regulator makes them clear through almost a continuous stream of bulletins, supervisory publications, speeches, congressional testimony. It requires, the proactive part of this requires actually hunting some of that stuff down and taking the time to read it. But I think it becomes an essential element in trying to get your arms around how to move from a reactive standpoint to a much more proactive one. The other thing I'd like to mention is that compliance is once again being looked at from the perspective of a consumer. This was a very significant feature of the CFPB's examination approach when the agency began 10 years ago, and it spread to the prudential regulators as well. And that perspective may have been a little bit clouded in the last few years, but is now returned, and we see it in the actions of the Biden administration as well as the agencies, the banking regulators and the CFPB already. Proactive compliance also presumes a culture of, if we could go back to the previous slide, a culture of compliance across an organization, and it aligns compliance and fairness with core business goals and ethical values. I think that's another key consideration here in sort of making that transition to a proactive approach. One of the other things that I'll mention is that proactive compliance is actually a key component of examination ratings that bank regulators assign to financial institutions that they examine on a periodic basis. It's a key element in determining that rating. One other consideration is that regulators do not accept fortuitous compliance as a valid outcome. Put another way, the absence of violations as one goes through an examination or looks at consumer complaints and other issues that are being raised is not necessarily enough to give the regulator comfort that things are being managed in an appropriate way. The regulators are looking to see if there's a solid framework in place that guards against problems before they actually happen. That framework itself has to be proactive. Proactive compliance is also looking beyond technical requirements and is fairness-based, and we'll talk about that a little bit later. Finally, in addition to the compliance management system, which we'll explore, the 3 lines of defense is an essential element. The first line, the business, actually owns the risk. The second line, or the corporate compliance function, sets and manages the framework. And the third line is the audit function, which helps evaluate the effectiveness of the first and second lines. Those work collaboratively with a compliance management system and as part of an integrated element of the organization's risk management framework and strategy. It also ties directly back to a risk tolerance. So we'll move to the next key driver. Val?
Thanks, Tim. So the next key concept behind the third wave of digitization is compliance first product development. And when I talk about product development, I'm using the term product very, very broadly. It might be an enabling technology leveraging a set of features or functions, or it could be your all-encompassing process, workflow, or the experience of a mortgage transaction from the borrower's perspective all the way through to the end of the life cycle of that mortgage. But the concepts of thinking about developing that product is going to be consistent, whether it's the technology or process we're discussing. So as Tim noted, we just discussed the transition to thinking about compliance proactively. The shift in mindset becomes critically important as you begin developing or implementing a digital lending solution. Compliance can no longer be an afterthought in your product development, as you risk re-engineering, delaying, or even abandoning your product after non-compliance is identified. Regulators are expecting compliance to be a steel thread in your product lifecycle. So beginning your digital journey on day one of that journey with compliance top of mind is imperative to your success. What does that really mean? It means considering every workflow and process or system touch point and understanding each of their unique compliance requirements and your risk tolerance towards non-compliance at each of those touch points. For example, if you're tasked with digitizing the loan process, your compliance requirements don't end when the loan is closed. You must also be considerate of the downstream compliance requirements for interacting with that digital loan package. You must consider your customer, your internal, and your business partner interactions and the compliance requirements for each of those interactions and touch points. Your software development, deployment, and support operations and policies are also affected by these compliance requirements. Ever-increasing security and data privacy requirements are obvious, but newer capabilities exposed through machine learning offer you the ability to incorporate automated auditing and verification into your processes, which allow you to build compliance confidence and enable you to proactively alter your direction before you fall out of compliance. Next slide, please, Mallory. And then with that compliance first product development, you can achieve your true system level compliance for the confidence that your lending product can stand up to regulatory scrutiny. The compliance needs of a mortgage transaction are many and vary from state to state or even jurisdiction to jurisdiction, as we see with remote online notary. The compliance needs become even more complex when you digitize the mortgage transaction and introduce not only the ability to leverage technology and automation, but also device and location independence. The use of technology may ease your ability to analyze at scale and on demand the compliance with fair lending practices, but technology can also complicate compliance with borrower protections. Too often we seek to simplify borrower experiences and may overlook the impact on compliance that simplification may introduce. You must consider providing parity in experience, whether that borrower is on the smartphone or on a desktop device, or whether they're at home with limited internet connectivity or storms as we're experiencing where I happen to live at the moment, or in a settlement agent's office. Digital transactions introduce additional compliance needs unique to the digital process. The industry is seen where those that do not embrace compliance first approach to digitizing their processes are penalized. The idea of simply applying technology to a traditional process is not sufficient in the lending space. You must consider how your traditional business might be affected by digital compliance requirements and be prepared to adapt. But the good news is if you develop your digital product with compliance at its core, you mitigate risk, enable asset level certainty, and gain stronger insights into your business, enabling you to advance your program with confidence. Next slide, Mallory, as we move on to understanding some of the essentials.
Sure, thanks, Val. So the whole concept of catching the wave is really part of the, or the whole phrase is really a part of the surfer's lexicon. But for our purposes today, what it really means for us is trying to seize on an opportunity. So in the next section here, we're going to talk about compliance and technology essentials for not only catching the third wave, but being able to ride it as well. So with regard to compliance essentials, the first thing that the thing that bubbles to the top for me is really having a very strong proactive compliance management system and framework for everything to sort of congeal around. That means ensuring that there are updated policies and procedures that actually match up with actual practices, controls, testing protocols for new product features, and looking at compliance on an ongoing basis, training of personnel and the business leaders in the organization, the involvement of the senior leadership, as well as something as simple as complaint program management. Another key element of a strong compliance management system is risk assessments that are valid, that run pretty deep, that actually do come up with and identify what the risks are that have to be managed and how they're going to be managed. Regulators expect not only you to have a very rigorous compliance management system, but they also expect anybody who you're partnering with to have a rigorous program as well. Talk about that in a minute. Another key element of the compliance management system is a regulatory change management component of that system. We could spend a lot of time on just regulatory change management and how to introduce automated activities into that to make it much more robust. But for today, what I'll really concentrate on in this bullet is ensuring that change management component brings in and encompasses all laws that the organization is subject to. That includes not only federal laws, but state and international as applicable to the organization. I think it also brings in any type of policy change, any type of additional regulatory guidance that comes out from the regulatory community, and taking a look at how that affects the business of the firm and how products are affected and how it's going to be assimilated and managed. The third thing that I'll mention is third-party risk management. Who are you choosing to do business with, and how are you managing that relationship? It's interesting to note that on the 13th of July, a month ago, the bank regulators released a proposal or some proposed guidance that invited public comment on some interagency guidance on managing risks associated with third-party relationships. What this would do is harmonize for the first time the agency's expectations and guidance on third-party risk management, which they believe has become a very significant supervisory priority in recent years. The proposed guidance would promote consistency in how they will assess banking organizations' third-party risk management, and of course that trickles down to those third parties. The proposed guidance would apply to all banking organizations supervised by the prudential regulators, and it would be based on guidance that the OCC issued in 2013 and builds strongly off of the 2013 guidance as well as an extended frequently asked questions document that the OCC released in 2020. The guidance itself, proposed guidance, notes that the use of third parties may present elevated risks to banking organizations and their customers, and banking organizations need to take a very risk-based approach to managing risks and to ensure that third parties operate in not only a compliant way, but a safe and sound manner. So it spends a lot of time talking about what the guidance applies to, such as certain critical activities of the regulated entity, as well as key features in planning, due diligence, contract negotiation, and oversight and accountability. I would recommend that you take the opportunity to read through it. And of course, if you believe that or feel that you would like to submit a comment, I would certainly encourage you to do so, because I think it's going to affect your business if it hasn't already. Finally, fourth, the transparency of product information and features that facilitate comparison shopping and a better understanding of product features. Remember, I mentioned this is a very compliance or consumer-centric world in which we're living right now, and I think this transparency notion becomes even more important. Transparency actually promotes that acceptance that I mentioned a little while back. It's also an essential element of fairness, and it ties directly to one of the most fundamental precepts of consumer protection law, which is the ability, or the providing consumers with the ability to make informed choices and to comparison shop. So if you have product features that are kind of shaded over by some slick marketing communications, where folks can't necessarily understand what all those features are, or people who are actually selling the product in ways that don't really reveal all of its nuances, those things present problems and come back later on to bite you. Transparency to me, and I think others in the regulatory community would agree, really means reasonable pricing, clear terms, acting in the best interest of your customers, driving a longer term relationship with them, being consistent in the applications of policies, providing for equitable treatment, and finally listening to customer feedback when folks raise issues about how that product, how they're working through, or their experiences with that particular product. I guess we'll move now to the next slide. Next slide is also another compliance essential slide, and this builds on this basic fairness theme that I mentioned. I'm not going to go through everything that's here. I just listed out some things that have happened in the last 6 months or 7 months or so that really show that the regulatory community is paying a lot of attention, again, to issues of fairness and responsibility in lending programs and in other services. So this is also one of those areas that deserves some significant attention. So this has always been an area that regulators have spent a lot of time on. But as I mentioned, there's been a very steady stream of activity here and releases from the regulators since the Biden inauguration in January. It actually began a few months before that. And we saw early on in January the president's executive order on racial equity. There's just so many things to mention. HUD is, after sort of honestly kind of fallen off the radar screen for a while, seems to have come back into the regulatory community with a lot of energy. They're making a lot of changes. A proposed reinstatement of their 2013 version of their disparate impact rule, which was replaced a little while back with a different version. Now they're moving back to the older version. Their position on sexual orientation and gender identity under the Fair Housing Act. Similarly, the CFPB did the same thing with respect to ECOA. Other things including reinstating parts of the Obama era affirmatively furthering fair housing rule that the Trump administration had kind of taken out of the picture. We expect there'll be a lot more coming from HUD here. We also see the agencies issued a request for information on artificial intelligence. Although a broad range of information is asked for in that document, there's a healthy focus on fair lending. Actually see the RFI as a pretty good thing in general, and the fact that all the agencies are involved is a good signal that whatever comes out of it will at least have everyone on the same page. There's also a lot of changes that I'll mention at the state level, and I think that's something that you also have to keep an eye on. Illinois recently passed its own community reinvestment and anti-predatory lending law. Pennsylvania had a bill that was, or CRA law, going through its legislative process. New York was looking at a change in their Community Reinvestment Act law that would apply the law to mortgage banks. Where that sits in that process, I'm not exactly sure at the moment. But it really does show you that not only are the federal regulators taking a lot of actions here, we're seeing it at the state level as well. And the state level, I just don't expect that, even though we have a different federal administration, I don't see the states backing down at all. There's been a lot of activity from the CFPB, and they don't even have a permanent director yet. Just a few of those things are mentioned here. So, I mean, I could kind of go on with each one of these, but as the more I talk, the more I keep thinking about something else I want to mention. But, you know, tied to all this, and I touched on it just for a second here, is artificial intelligence, and Val mentioned it too. Artificial intelligence, machine learning, alternative data, but I'm looking at it from the standpoint of how that's used in a lending context. The technologies themselves can open a lot of doors to credit access for many, but they carry some risks that need to be managed, and those risks give rise to whether additional regulation and exam scrutiny is needed to protect consumers from harm. There's also an interesting problem here, and that is we all want more access to financial services, and the technologies can help, but at the same time, overregulation could certainly kill them and defeat the purposes altogether. A few other releases from the CFPB include some guidance on limited English proficiency, special purpose credit programs, which had been kind of a sleeper for the past 40-something years. We see the CFPB also stepping up on their hiring of enforcements and hiring of attorneys and reinvigorating their enforcement team. Finally, I think we're all going to see by September, perhaps, or by the end of September, some proposed regulations that would implement Section 1071 of the Dodd-Frank law. And that deals with the collection of information and disclosure of information, range of information on applications for credit made by women-owned, minority-owned, and small businesses. I think there's going to be it's going to be a really huge challenge to be able to compile all that, collect it, compile it, report it to the government, and there'll be no shortage of folks who are going to want to get their hands on it to read through and understand what that may mean. So that's just another thing I'll also add to the mix. All the regulators are paying attention to the whole concept of appraisal bias, not just the CFPB. But that's where I'll kind of stop with the list for the moment and just sort of say, well, you know, where does that take us? It kind of takes us back to the basics here. And the basics are really reacquainting yourself with risk indicators and the interagency fair lending exam procedures, the types of evidence that's used in redlining investigations, pricing, mortgage servicing, which is very hot again. And of course, having a wraparound for all this, which is a comprehensive assessment of your fair and responsible banking program, which of course ties into your compliance management system, I think is a key step. Val?
Thanks, Tim. So Tim just helped us go through what does it mean to catch the wave and ride the wave from a compliance perspective, but then let's look at it from a technical perspective. So what are some of the key takeaways that you need to be aware of as you're looking towards a technology to help you digitize your lending process? So firstly, you want to seek to replace manual compliance analysis with automated workflows. These automated compliance methods free up resources and empower your compliance teams to focus on the root cause of the problems where you did not satisfy compliance, rather than running around to put out fires or to identify areas where you might be missing compliance. So they allow you to be a little bit more proactive and preventative. Secondly, you want to look towards deploying analytical tools to review your lending patterns. Analytical tools provide valuable insights into more subjective regulations. For example, analytical mapping tools can help evaluate CRA and fair lending compliance. Using these types of tools, lenders can identify how the financial institution is serving the needs of low to moderate income borrowers in their service area. Can also identify potential gaps in compliance or evaluate new areas to expand services that increase your fair lending performance and mitigate your risk. As noted earlier, achieving parity in experience is critical. Borrowers have come to expect a mobile and remote experience. You must be able to offer that experience with the same level of compliance and satisfaction or greater than you would in paper, in person, or on a larger screen. Finally, recognize that security and compliance often go hand in hand. Strong know your customer, identity verification, and customer information protection technologies, as well as general information security practices, are a must for any digital solution as they serve to protect both you and your customers against fraud and privacy concerns. It's also interesting to note how regulators are adopting technology to catch compliance. Tim, is there something you'd like to share with us in terms of what you're seeing in regards to this area?
Well, I do think that regulators have always tried to embrace the power of technology for conducting examinations. I mean, even going back decades and decades to the use of calculation tools that help people with annual percentage rates, for example. But I think at a much more sophisticated level, what we're seeing now is the regulators not only embracing but encouraging organizations to use that technology to help identify or use it to identify problems before they happen. We see that particularly in one good example is with anti-money laundering programs and under bank secrecy related stuff. Where not too long ago, maybe a year or so ago, they came out with something that really encouraged the industry to step up and use that technology. I think we're also seeing the fact that the use of technology can help prevent or identify problems before they actually become violations. Just simple things like we put in the slide here, like a missing signature or something that goes through documents digitally before they're released or put in final form or closed out as part of the closing package. Things can help there to sort of stop problems from happening before they exist. So I think we're seeing not only the agencies looking at different ways that they can use it, but they're actually actively encouraging, I think, the industry to do it as well.
Thanks, Tim. Mallory, next slide, please.
So, Tim, actually, I have a question before we get to the key takeaways. When you're utilizing technology today, for instance, if you're using the original, you're able to track pretty much everything that occurs around a mortgage transaction and when it occurred and by whom. Do you think that the regulators are going to be able to use this in terms of enforcement? That could be an inhibitor for different businesses, or do you think this is going to assist both parties?
I think it would actually assist both parties, Steve. I mean, put the way you asked the question, yeah, I would have to say that it could cause some folks to sort of say, hey, wait a minute. But on the other hand, I think if it's effectively working and it does what it is that we're talking about today, which is all done in the context of a compliance first type of application. In other words, that we're looking at compliance first in working through the product and the e-closing itself, and it's built that way. The likelihood that there's a trail that actually enables you to show a regulator what you did to comply, I think is actually something's very helpful.
Thank you. Well, thank you both, Tim, Val, very much. What we wanted to do is just take a sort of in summary of a few points. The first of these is what Tim was discussing is moving from reactive to proactive. Most regulatory compliance, a regulation is issued, and then you really attempt to figure out how you're going to comply with that, what's the risk in managing that, but really becoming more involved, more proactive is really, really critical. And to do that, you have to have as Tim described, that risk management framework, and you have to have a compliance first management system and be able also to track, to know not only what is here, what is there, when what is here now and what is coming, but like how this is going to affect all of your business processes. Mallory? Here we go. First and foremost, that lending compliance digitization is an imperative. This is not an option. If you were listening to Tim's last slide and going through all the myriad of issues that need to be addressed in a cohesive manner at whatever extent possible, from having a digital compliance platform to be able to fulfill the requirements that, again, are coming, that he described, but also the ones that are here. We're going to see a different world in the end of 2021 and going into 2022. So it's really not an option. This is going to be something that you're going to need. And from a regulator's perspective, it would put you in a better light with the regulators, but also be able to give your risk management folks a great deal of confidence. And the last, compliance first product development. So this is something that both Walters Clory and the original have been focused on for a long time, meaning getting ahead of it, looking at compliance, when you are building the product, when you're building the application, when you're building the interface for your customer and your customer's customers, that you are looking through that compliance first perspective or that lens, so that you don't end up at the end saying, oh, we missed something, or this isn't going to fulfill this particular aspect of this regulation or this particular rule of law. So having the design of the product, the design of what you're going to be offering is absolutely critical, and to have client compliance built into it is we often say a purpose-built product, purpose-built for compliance. Val, is there anything you'd like to add?
No, I think just really, again, reiterating, thinking about compliance, your requirements, not just for your immediate business problem that you're trying to solve, but for the entire workflow, your entire transaction, and potentially even the entire life cycle duration of that transaction. Be thinking about not just a point in time, but the entire time.
Thank you, Val. Tim?
Just one thought, and that is, and I think we've touched on it in different ways today, and that is what this concept sort of brings us to is the ability to use compliance as a competitive advantage. It's touched a little bit on it in that first bullet up there, Steve. And I think Val and I have also mentioned, as well as yourself, it becomes a differentiator. And, I think that the technologies that are going to succeed are those things that are sort of built from the standpoint of in a compliant environment that will set you apart from competitors. It also, I think, puts you in a position where when needed modifications to products, I think we mentioned that as well, or when changes to products are needed, starting from the standpoint that you already have something that's in compliance and then building on top of that becomes a lot easier than sort of having to start from the ground up again. And I think that's really what part of that third wave is really all about.
Thank you, Tim. Mallory, do we have any questions from our audience?
Thanks, Steve. I don't see any questions yet, but if you would like to submit a question, you can do so at this time. We are going to quickly address Ezra's public policy. Margot, if you would like to take it from here.
Sure, just a couple quick observations on the presentation, which was fantastic. Having been an advisor to clients over the years and years, helping them go digital, all of this is sort of music to my ears. That here we are, pandemic. I won't even say post-pandemic. I'd like to say that, but we're getting there, where digitization is really becoming a necessity in order to operate. And once it's become a necessity and people are comfortable with it, I don't believe that we'll ever go back to a fully, paper environment. So thinking about the law and compliance and weaving it through technology platforms is, has to happen. And sort of that mixing of or interdisciplinary approach where you have business, legal, tech, data security, and privacy, compliance folks, all of the design team working together is now even more critical than ever. It's not the Wild West out there. We get questions all the time. It's like, well, yeah, but it's easier or it's faster. But yeah, it may be, but there are laws and regulations that still matter and need to be adhered to. So there has to be a balance. Yes, there's ways to use a digital process to make the consumer engagement more meaningful, but it doesn't mean you skip a bunch of steps in terms of enabling the consumer to review and retain and understand the process and transaction. In addition, in addition to the sort of the regulatory focus, which for the past, I don't know, a few years, it's been maybe less than it has been in the prior 4, 5, 6, 7 years, but the courts have been incredibly active, supporting digitization, but yet saying, hey, wait a second, not so fast. This concept of unfair and deceptive acts and practices, the net impression of the consumer customer, what is it, even if you have full technical compliance, what is the impression that the consumer customer is walking away with? Do they need to, press that button in order to continue? What is the button labeled? So, for those of you who are working on compliance solutions, looking at the court cases and enforcement matters are excellent guidance as well. And I guess, I'm curious, Tim, Steve, Val, your thoughts on looking and talking about ESG, environmental, social governance concepts, and kind of marrying that up with third-party risk management, and having, digital offerings are critical now to being able to be in business and business continuity and all of those concepts together, whether, that should be added to the sort of list of, hey, governance, risk management, business continuity, being able to continue to engage with your customer, even if they can't come into your office, branch, what have you. So I guess I'll turn that to you three to see if you have any comments.
I could offer just a general observation, and that is, I think in what I've been looking at from at least the bank regulatory community, that's the place where I spend most of my time. I think on one hand, the regulators have been very, very complimentary of the industry's ability to be resilient in continuing to provide services to the public, and in the adaptation of or changes to how they deliver products by using technology. But at the same time, I think they also see the need for that business resiliency to continue, because as you very appropriately mentioned, we're not really post-pandemic. We'd all like to be, as you said, but I think that we may have a little ways to go here before we get there. But I think what it has really shown is that the industry can adapt and pivot very quickly, and that resiliency and ability to continue to respond in that way is really something that I think they're going to probably be looking at in the context of future supervisory activities of the industry. So just a general observation that I'll throw out there.
And Margaret, I'll comment. I think the idea of including digital transactions, remote transactions as a consideration for your business continuity plan is certainly important, but I would definitely caution those to, think about that and what those plans are with compliance first, because there are very specific requirements depending on what industry you're in to how you transact digitally, and you need to be aware of those before you just jump into a a digital alternative to your traditional offering.
Very good. So I'll just quickly mention Ezra's public policy initiatives. The organization has a robust public policy committee. There are a number of ongoing advocacy efforts in all of the areas, as well as others, all of the areas that are noted on the screen, as well as others. Electronic will legislation is being supported, acceptance of e-signed IRS forms, as well as any other form that needs to be filed with the government, notwithstanding Government Paperwork Elimination Act efforts. There is at times a form by form approach at many of the agencies. So we try to kind of work on educating and advocating for broader acceptance. Our blockchain efforts have been to support uniform technology neutral legislation. There's a lot of activities at the state level where states are either amending the Uniform Electronic Transactions Act or creating new law to enable blockchain electronic record and signature use, and our position has been e-sign and the UTA are sufficient in order to do that. We are working with the Uniform Law Commission and the Chamber of Digital Commerce on that sort of uniform position. Ron, everything these days is remote online notarization. We have a large tech vendor coalition within Ezra that is spending a considerable amount of time ensuring that states are enacting uniform RON legislation. We continue to work with the Federal Reserve banks and the Federal Home Loan Bank Board in terms of accepting e-notes as collateral. There's a lot of activity and there's been a lot of success in vehicle titling. We have a number of members that primary business is in that space and have had good success, again, having state agencies understand the need for electronic signatures as well as the e-odometer statements. If you're interested in joining Ezra, there's a lot to do and a lot that you can participate in. Of course, we hope that you would join Ezra and gain the benefit of the combined expertise of our members and also support, advocating for digital transactions. Again, membership section on our website, www.esignrecords.org. Tim, Valerie, Steve, thank you so much for your participation today. Really insightful and interesting, and excited to continue to ride the wave, catch the wave, ride the wave, and successfully navigate the waters as we go through.
Our speakers did an excellent job covering all of their material today, so I think that's a wrap. Thank you for attending today's webinar, and thanks again to our speakers for sharing their time and expertise with us this afternoon.